In this video, I'm going to talk about why I believe interest rates are going to remain high throughout this year and next year, and talk about some of the telltale reasons of why and some of the signs to watch out for when there is going to be movement. We're going to talk about some of the risks in the global economy right now and how that could affect us. So join myself and 12,000 other subscribers on the channel, and I'll catch you on the video. Hey, it's Payam here from Niche. Hope you're well. Right, we've had some statistics, and it shows that we're in big trouble here. The economy in July retracted by 0.5%. So that's a big retraction, and that just shows that what they've been trying to do, slowing down the market, is actually working. Now, don't be fooled by all these people coming in and long-faced and telling you, oh my God, you know, this is not great, this is not that. That's what they exactly wanted. They wanted to slow down the economy. They wanted a recession. They were working towards a recession. Now, the controlled recession, but essentially that's what they wanted. They want everything to slow down. It'll be interesting because we have seen signs that some of the high street lenders have actually reduced their rates over the last week or two. Okay, in fact, we saw Nationwide yesterday reduce some of their rates. Now, bearing in mind, you've got the Bank of England base rate committee meeting up, and it's pretty much expected that it's going to go up by 0.25. These figures will have some impact in that decision-making process, because what you don't want is a full-on downward spiral when it comes to economic activity. So yeah, there's certainly problems out there. We're seeing numbers in regards to mortgages that have been arrears. They're jumping up massively. You've seen landlords actually be the worst off in terms of arrears. Landlords are by far, it's probably 3 to 4 times more arrears for landlords than residential owners. And of course, residential owners have got the protection of going into an interest only for a couple of months and moving around with their terms. So they are more protected than the landlords out there. Yeah, it's going to be a ride. I think 2024, it's going to be certainly interesting. I've seen it. I've seen with the level of inquiries that I've had in the last couple of weeks. I have to say, guys, the type of interactions I've had, and I've been doing this for over 15 years now with Niche anyway, and I've been in the mortgage industry for over 20 years, more than that probably now. But the type of clients that I'm seeing, certainly from an investment perspective, not so much the first time buyers, next time buyers, they seem to be a lot more pushy. There seem to be a lot more, there's a lot more aggression around. There's a lot more urgency in the matter. And I just feel the sort of tightness in their situation. So it'll be interesting to see how this all plays out in the next couple of weeks. I think we're going to still see rates be very, very sticky. I think interest rates are going to be there for longer, actually. They're going to be higher for longer. I initially thought we'd probably start seeing the slow down on the interest rate rises and maybe a downward trend towards the end of the year and the beginning of next year. But I think the interest rates are going to remain high, and there's a couple of reasons for that, right? So reason number one, America. Okay, I've talked about this before. America is at the moment, it's got interest rates of around 7, mortgage rates of around 7%. Okay, 7% in America. That's the highest in 25 to 27 years, right? Applications, mortgage applications are at all-time low, right? Inflation is actually half of what we've got here. However, they've still kept interest rates high. Okay, so that's number one. Number two, China's slowing down. What's China doing? China is going to start flooding the market with lots of goods. Okay, China is also printing a whole load of money. That money is going to come into everywhere, okay, globally. Okay, that money is going to have an impact in inflation. That money is going to be swishing around, because what happens, all of the wealthy in China are pulling their money out and they'll start investing in other places. So it will affect inflation in other Western safe haven countries. Okay, and I think them printing billions and billions and maybe trillions of their money is going to have an impact in the global economy, which means we're trying to slow things down. They're trying to make things go faster because the economy's slowing down in China. That will have an impact in manufacturing. It will have an impact with a lot of the things that we are tied into them. So that's number 3. Number 4, I think that at the moment interest rate will remain low, because I'm worried about what's going to happen with the Ukraine war. We're not to the end yet, and I think, you know, we've got a winter coming. We were very, very, very lucky that we had a mild-ish winter last year, and obviously there have been sort of backup supplies and bits and pieces. But if it's a bad winter and energy starts getting drained and we need to burn more fossil fuels, I think we're going to be in trouble. We've already seen the price of oil jump up. Oil is at it's getting there. It's $92 a barrel. Okay, so that's going up. That's creeped up. Okay, over the last couple of months, and that's why I think interest rates will remain high, certainly for the next year. So bear that in mind if you're going for a 2-year or 5-year fix. I've said before, I've got a mortgage coming up I've got a buy-to-let mortgage coming up in March, I think. So it'll be interesting to see what I'm going to do. I'll tell you what I'm going to do. 6 months beforehand, I'm going to probably get a mortgage, okay? And then I'll sit tight, and if it's a good deal at that time, then I'll keep it. If it's not, then I'll swap it. But I will be looking at my options there. These are the reasons why I think that our economy is in a real dire situation. You only have to put on the news, you know, nothing's really working. There's all sorts of problems, and it's all great blaming it on the immigrants and blaming it on that, but fundamental issues with our economy is nothing to do with the guy on the boat. It's got to do with lack of investment. It's got to do with the problems that we've had for many, many, many years. It's the unbalanced way our economy is. It's so geared towards financial services, and I think we're going to get hit the worst if there is a recession, because money is going to be tighter and banks are going to be under pressure. Now, I saw a couple of influencers a couple of days ago. They made videos around the difference between 2008 and where they bought all these properties in 2008 when there was a crash, and now they've done so well, and this is going to be the same thing. It's not going to be the same thing. I was actually in the mortgage industry in 2008, okay? I was a marketing director for one of the largest mortgage companies in the UK, okay? That we had 450 staff in Tottenham Court Road, writing billions and billions. I think in 2007 we wrote 7 billion in mortgages, okay? That through our network of brokers, right? That's more than some of the high street banks are doing right now. Okay, and let me tell you this, right? The difference between 2008 and 2000 right now is 2008, it was a liquidity problem with the banks, okay? The Bank of England came in and reduced everything, reduced all the rates, okay? So although there was repossessions for the people that had property and, you know, risked it all, the problem was, the good news was, interest rates remained very, very low. So you could make that rental calculation work. Obviously, properties were a lot cheaper as well, so the loan to values. We also didn't have all these rules that we have to abide by. We now have got the residential rules under the under some of the residential rules that have come in that made it harder with the stress testing and everything. Thank God, because there would have been a lot more repossessions. Obviously, self-certification mortgages, all of those things went out of the window. But now we've also got all these stress testing, and I've made a video on this where some landlords are being asked to pay thousands and thousands and thousands of pounds for having the pleasure of borrowing some money. And we're talking about 3%, 4%, 5%, even 7% lending fees on buy-to-let mortgages on hotspots in central London, because they can't make the rental calculations work. It's all right if you're in Dudley, or if you're in, I don't know, Liverpool, or you're in Blackpool, you can make the rental calculations work because average property prices are quite cheap. What if a property price is £1 million and you've got 500k mortgage on it? You're still sitting at 50% loan to value. However, to get a rental that fits the rental calculation for a £500,000 mortgage, you are screwed, because the way the majority of the lenders work, you just can't make the rental calculation work. So you're having to pay a lot of money. What's that going to do? I've had lots of comments saying, good, those bloody landlords, they deserve it. They deserve to be hit. They don't understand those landlords are actually just going to push push the prices up on rent, and we've seen rent increases massively. Okay, so that's going to add to inflation, right? We've seen wage growth actually get larger than inflation figures, so everything's being pushed up, and this is not going to do us any good in the future anyway. So what we think is, I think personally rates are going to remain high. I think it's going to be sticky. I think we're going to have good months. I think we're going to have bad months. We're going to have good months, but I think rates will remain. The factor I would be watching for is what the US is going to do. Okay, if US starts shifting, if US starts moving the rates down, adjusting things, if US starts slowing down, then I think we will see a movement by the Bank of England. I don't think they're going to be brave enough to move anything by themselves. I don't think they're even going to look at Europe. Normally there would be a bit of an agreement between us and Europe to see where the interest rates are, but I think Germany's in a real bad problem at the moment. Germany's a manufacturing powerhouse and they're struggling, and guess what? They're now going to have to deal with billions and billions worth of goods from China coming in at discounted rates, because China is slowing down and it's going to need to kickstart their economy even further. Anyway, let me know what you guys think, and I'll catch you on the next video. Take care. The content of this video does not constitute giving advice. It's purely for information purposes. All cases should be discussed with a professional mortgage broker. As a mortgage is secured against your home or property, it could be repossessed if you do not keep up mortgage payments. Niche advice is authorized and regulated by the Financial Conduct Authority.